Hi, I'm Ira Koyner, the original IRA and founder of Triathlon Partners. Today we're breaking down something that confuses a lot of people: life insurance. Let's keep it clear, practical, and focused on helping you make a smart decision. Now, there are two types of life insurance: term and permanent. Well, term insurance provides coverage for a specific period of time, usually 10, 20, or 30 years. If you pass away during that term, your beneficiaries receive a tax-free death benefit. If you outlive the term, the policy expires and there is no death benefit. Now, the pros of a term policy is that it's very affordable, especially when you're younger. Simple and easy to understand. It's ideal for income protection, mortgages, and short to medium term financial responsibilities. The cons is that you're renting insurance. There is no inherent value in the policy, and the coverage ends after the term is over. In addition, if you would like to renew your term policy and your health changes, it can be quite costly or maybe impossible to get new coverage. Now, permanent insurance is designed to last your entire life and includes a cash value component that we can think of as an investment. And this investment grows tax deferred, but it comes at a higher cost than term insurance. Cash value component, again, is an investment and it grows tax deferred. It can be borrowed against to fund retirement or other expenses. And the borrowed funds are tax exempt, meaning that you are creating a cash flow like a pension that doesn't get taxed. That's why permanent insurance is an excellent investment for high net worth individuals in top tax brackets. Now, there are two types of permanent insurance: whole life and indexed universal life. Whole life insurance guarantees a death benefit and level premiums. There's a guaranteed cash value accumulation over time. And the insurance companies may pay annual dividends, which have historically been similar to 10-year government bonds, which are between 4 and 5%. The pros: it's a very predictable policy as long as the premiums are paid. Right? The premiums are structured, they are very rigid, and if you do not pay them, you can get into some trouble with the policy. There is a guaranteed growth of cash value, and again, you can borrow against the policy tax-free if it's structured correctly. Now, the cons are they are the most expensive form of life insurance. It is a very rigid and not a flexible policy. Cash value is slow growth, and the costs to access your cash are quite high when compared to other types of policies. Index universal life is a permanent life product that is much more flexible. Okay? The cash value grows based on the performance of the stock market, and therefore the investment can grow quicker, and it also grows tax deferred. The investment is based on a cap and floor structure, meaning that every investment year there's a floor on what the investment can earn, and that is a 0%, which means the investment cannot lose money in any year. And there's a cap on how much the investment can earn every year. Now, these caps vary, but right now the caps on popular indexes range between 10 and 13%. And for additional fees, you can get that cap up to as high as 25. Now, that is a tremendous amount of upside that you can participate in. Now, the pros of this policy are: number one, the investment has substantial potential to gain, and those gains are tax deferred. The premiums are very flexible. If the policy has been doing quite well in the market, you can decide not to pay a premium. There is no penalty, right? And when you want to access the money, the tax exempt withdrawals have low fees associated with them, much lower fees than with whole life. Now, the cons of this product is that it is a complex structure. So you must understand the caps and the floors and monitor the policy year after year to make sure that it's aligning with your goals, right? Because if you do not monitor it and you do not have experienced professional advisor working with you, the policy could be in danger of lapsing, meaning that there is no more insurance on it. So, in summation, there is no one-size-fits-all in life insurance. Term may be perfect for covering a 20-year mortgage, future college expenses, and an income replacement. Whole life might be ideal if you value guaranteed returns and a death benefit growth, if you know you can afford to make premium payments for 20, 30, or 40 years. Index universal life policy may be more strategic if you want tax advantage stock market growth with downside protection. This product can be part of your overall investment profile and lessen the amount of risk and stock ownership you hold in your brokerage accounts. If you'd like a personal recommendation or want to compare illustrations, visit www.triathlonpartners.com or reach out to me directly. I'll help you understand what fits your needs now and in the future. Thanks for watching, and don't forget to like and subscribe for more insights on building wealth with protection. This is Ira Koyner, the original IRA from Triathlon Partners. Have a blessed day.